The Fed's move, understanding the impact of continued rising interest rates on financial markets. The Federal Reserve is the central bank of the United States and has a significant influence on the country's financial markets. The Federal Reserve was established in 1913 with the goals of promoting price stability and increasing employment. So, the monetary policy, which includes setting interest rates, plays a decisive role in influencing the economy and financial markets. When the Fed raises interest rates, it makes it more expensive to borrow money, which slows economic growth and lowers inflation. When the Fed lowers interest rates, it makes it cheaper to borrow money, which stimulates economic growth and increases inflation. In the past period, the Federal Reserve has gradually raised interest rates, and this has had serious consequences for investors, businesses, and consumers. When interest rates rise, it can have a negative impact on stocks as higher interest rates can reduce corporate earnings and make bonds more attractive to investors. On the other hand, higher interest rates can benefit the bond market because higher yields make bonds more attractive to investors. The real estate market can also be affected by the interest rate decisions of the Federal Reserve. When interest rates rise, it can reduce demand for mortgages and lead to a slowdown in home sales. However, higher interest rates can benefit the real estate market by making it more attractive to investors looking for a safe haven from the volatility of the stock market. Higher interest rates affect the currency market as well. In general, higher interest rates can make a country's currency more attractive to investors, causing the currency to appreciate. Continued rate hikes by the Federal Reserve could have a host of consequences for the economy and financial markets. A possible slowdown in economic growth and an increase in inflation are some of the possible consequences of a continued interest rate hike. In addition, higher interest rates can reduce consumer spending, as consumers have to pay more for loans and mortgages. On the other hand, raising the interest rate can also have some benefits. For example, consumers may benefit from increased savings and investment opportunities because higher interest rates make saving more attractive. And the continuous interest rate hike can lead in the long run to strong economic growth, as happened in the past. Investors and traders can prepare for the impact of monetary policy by a diversified investment strategy that includes a mix of stocks, bonds, and other assets. By understanding the role of the Federal Reserve and the impact of rising interest rates, you can better prepare and make the appropriate decision. Thank you for watching. Do not forget to like, share and subscribe. Until next time, happy investing.